The accounting equation and transactions. We will look at the accounting equation and how it relates to the financial statements as well as the transactions from Chapter 1. The accounting equation. What we have are the assets, which are what we have, and we get them by either owing on them or owning them right out. What we have is considered our assets, and what we owe are considered to be our liabilities. What we own is considered to be stockholders' equity. Both assets, liabilities, and stockholders' equity are all found on the balance sheet. However, there are very many categories and types of accounts underneath stockholders' equity. So for stockholders' equity, when you have an account there, many different financial statements will be involved. Whereas when you have assets, only the balance sheet will be involved. When you have liabilities, only the balance sheet will be involved. Assets are of different types. We're looking at one here called cash. There's also accounts receivable when someone owes you money. There are also supplies which are considered to benefit more than one period, so it is not supply expense. It's considered to be almost like a storeroom of supplies. And you can also have a large asset such as land. Liabilities usually come in the form of accounts payable, which are due usually within one accounting cycle, as well as accrued liabilities for things such as salary and perhaps rent. Additionally, there could be a formal agreement known as a notes payable, showing that you owe somebody money and you've signed a note in relationship to that. All of these will all be found on the balance sheet. Now let's talk about what's in stockholders' equity. Stockholders' equity is comprised of common stock, so when investors invest in the company, they're given common stock. Common stock is always found on the balance sheet. Next, we could have retained earnings. These are earnings from revenue and expenses retained by the company, and this is found on two financial statements. It's found on the balance sheet as well as the statement of retained earnings. It is one of the only account that will be found on two financial statements, retained earnings. Additionally, when we're calculating ending retained earnings on the statement of retained earnings, we also include dividends. This will be also on the statement of retained earnings. Next, under stockholders' equity, we have revenue and expenses. Revenue and expenses are only found on the income statement. Retained earnings increase stockholders' equity, common stock increases stockholders' equity, and revenue increases stockholders' equity. Dividends, however, decrease stockholders' equity, and expenses decrease stockholders' equity. Let's look at some transactions. Here we have one. We're going to set up a asset, the accounting equation. Assets are equal to liability plus owner's equity. And to use common English terms, we'll say what we have is equal to what we owe and we own. We know that all of the assets will be found on the balance sheet and all of the liabilities will be found on the balance sheet. The stockholders' equity, the accounts will be found on many different financial statements. So here we're going to record what kind of financial statements associated with. And over here, we're going to look at how these accounts affect the financial statements. We prepare the income statement first. We take the net income from the income statement, which is revenue minus expenses, and we use that in calculating the statement of retained earnings. We add net income to any beginning retained earnings, and we get a subtotal from which we deduct dividends, and that will give us ending retained earnings. That ending retained earnings is also found on the statement of retained earnings and also too under the owner's equity section of the balance sheet. Ending retained earnings will be found there. After we've calculated the ending retained earnings from the statement of retained earnings, next we prepare the balance sheet, which is comprised of all of our assets using the total amount of those assets. Then, and in relationship to that, we look at the total amount of our liabilities and then the total amount of our stockholders' equity. We add our liabilities and stockholders' equity together, and we make certain that it agrees to our assets. The balance sheet essentially represents the accounting equation. So in this first transaction, the owner invests in the business in the amount of $30,000 and he obtains common stock. So cash is going to increase. Common stock under owner's equity will increase. We see it through this transaction, the accounting equation stays in balance. Next, we're going to purchase some land for cash in the amount of $20,000. This transaction involved two assets. We exchanged our cash for land. So in this instance, our cash went down, but our land went up. Our balance of assets is still $30,000, and the balance in owner's equity is still $30,000. Next, let's look at a purchase of office supplies on credit. When we're looking at this, we're saying the two accounts that would be affected would be supplies and then also the amounts on credit or accounts payable, because we're going to pay that off in 30 days. Now we're assuming the supplies will benefit more than one period, so that $500 goes to supplies. And $500 went to accounts payable. So both sides of the accounting equation increased by $500. Next, we earned some revenue which was paid in cash. So the two accounts involved are revenue and cash. Cash went up, so we're going to show positive number next to cash, and revenue went up in the amount of $5,500. Also, revenue is only found on the income statement, so the income statement is the financial statement involved. Both sides of the accounting equation increased. Next, we earned revenue and money was due on account. So in other words, we earned revenue, so revenue is involved, but we didn't get cash for it. It's money due on account. So that's called accounts receivable. So when someone owes us money, that's called accounts receivable. So they paid us what they promised to pay. So this is an asset because it's something that we have as a value and will benefit future periods. So the asset, accounts receivable, went up by $3,000. Also, our revenue went up by $3,000, and it affected the income statement. Remember, only two items are on the income statement, revenue and expenses. Next, we're going to pay some expenses with cash. So expenses are involved in cash. So since we're using cash to pay our expenses, we'll show that cash went down, putting the $3,200 in brackets, and we paid two different types of expenses. We paid rent expense in the amount of $2,000, it goes in the income statement, and salary expense in the amount of $1,200. Again, that went on the income statement. Next, we're going to pay off our accounts payable. So since we're paying this, we're using cash, so cash has to go down. So we're going to demonstrate cash going down using cash in parentheses, and also our accounts payable went down. We no longer owe as much as we once did. So our accounting equation stays in balance. Again, both of these are assets and a liability, so they're both found on the balance sheet. Next, we're going to collect our cash from our accounts receivable. So since we're receiving cash and accounts receivable was involved, this is going to be two assets accounts that will be involved. So our cash went up by $2,000, and also our accounts receivable went down by $2,000. So we'll show the $2,000 in parentheses to show it was a negative number, and our accounting equation still stays in balance. Next, let's look at some dividends that were distributed to stockholders. Dividends would always be paid in cash, and the amount was $5,000. So cash went down, and also stockholders' equity went down. Dividends are denoted with a negative number, and that's on the statement of retained earnings. So our total liabilities, our liabilities to $2,000, our total owner's equity was $30,300. Our total liabilities and owner equity, $30,500, and that was also the total amount of our cash. Now let's look at the preparation of the income statement. Statement of retained earnings and balance sheet, always prepared in this order. Our revenue was $8,500, and you can see that you would have to add up these two amounts to get the $8,500. And as I spoke about in class, this is just sort of training wheels to let you see what's going on. Big picture with regard to the accounting equation, but this is not how we really keep books. Again, we're going to deduct rent expense and salary expense, and we'll come up with our net income. There was no beginning retained earnings, so this is the beginning of the company. The net income from the income statement is used to calculate ending retained earnings on the statement of retained earnings. So our net income is $5,300. Our subtotal of adding beginning retained earnings plus net income is $5,300, and then we paid out dividends in the amount of $5,000. So our ending retained earnings was $300. Next, we had cash in the amount of $9,000. And again, this is not an efficient way to keep your books because you would have had to have added up all of the individual pluses and minuses having to do with cash. And that's rife with an opportunity to make an error. So again, this is just big picture, but our cash is $9,000. Our accounts receivable started out as $3,000, and then somebody paid off a portion of theirs. So it was $2,000 was paid off, meaning the ending balance was $1,000. Supplies were $500. The land was $20,000. So our total assets $30,500. Our accounts payable, we started with $500. Then we paid on it $300. So that means the remainder of it was $200. The common stock that was issued was $30,000. Our retained earnings, our ending retained earnings from above, is $300. So our total liabilities and owner's equity, $30,500. And we can see that the retained earnings is both on the statement of retained earnings as well as the balance sheet.